Good morning from London. I'm Anna Edwards alongside Guy Johnson and Valerie Teitel. We're an hour away from the opening trade. Here's what you need to know. Fixed income trading boosts BNP Paribas and Deutsche Bank income as both lenders beat estimates in a busy day for European earnings. We will hear from the BNP CFO shortly. Global stocks hit a new record high on trade optimism with signs of progress in EU-US negotiations. Plus, the ECB is expected to pause rate cuts for the first time in over a year amid uncertainty around President Trump's tariff plans.
Let's check in on how these markets are faring 1 hour until the opening trade. S&P futures in the green. We have notched a record high for the U.S. markets every day this week. Euro Stoxx 50 playing catch up this morning, up 1.3%. The euro is flat, but it has been a great week for euro dollar, up around 1.25% on the week. The U.S. 10-year yields are trading steady, just hovering right below 440. The countdown to the opening trade starts right now.
Thursday morning, good morning. The trade narrative absolutely front and centre. That is where the market's focus is right now. But you've also got to fold in a series of earnings. And these earnings are so indicative of what is happening below the surface with these markets right now and with the global economy. We'll go through them over the next hour or so. We've got some fantastic interviews lined up. We now get Lloyds. It's breaking onto our screens right now. We've got a series of big numbers coming through. And there's some themes that are really beginning to emerge from all of these.
Yeah, absolutely. And maybe Lloyds will set some themes for the UK retail banking space because it's the first of the big retail banks in the UK to report the pre-tax profit number coming in above estimates. That's the sort of headline. It's the red headline across the Bloomberg terminal, £1.99 billion. The net interest margin looks to be broadly in line with where they'd anticipated it would be. No further charges relating to motor finance. This is interesting. We're waiting for a ruling from the Supreme Court in the UK about whether sufficient disclosures were given to consumers when they were taking out lending around motor loans. So that's something we're going to be watching, but we're waiting for some legal moves, really, and legal decision-making on that front to get any further news and guidance reaffirmed. And actually, that was one of the themes that stood out to me. I know there's a lot more beneath the hood, but there was quite a few businesses confirming or reaffirming guidance this time around, maybe with some caveats, but that does seem to be something of a trend this morning.
Total is just breaking. I'm just trying to find the net line just to see where we are as it scrolls past me. Looks like it's pretty much in line with expectations, maybe slightly below on some key metrics. Oil prices have come down obviously reasonably sharply, so that's a factor, and gas trading has been actually reasonably... There's been a lack of volatility in gas trading, which takes me on actually to talk about what is happening with the banks. And I want to talk about the banks this morning because you've had a couple of names out, and we're going to be speaking to BNP Paribas very, very shortly. You mentioned Lloyds, but it doesn't have the kind of trading performance story attached to it that other banks do. But you've had Deutsche Bank out this morning, really strong FIC numbers. You've had BNP Paribas out this morning, really strong FIC numbers. The last quarter had a lot of volatility in it.
We remember.
we certainly do. Hard to forget.
Yeah.
The next quarter, the current quarter, less so. Look at what is happening with the MOVE index. Look at what is happening with the VIX right now. There isn't the kind of volatility. So is this the kind of the near-term high watermark in terms of some of those very strong trading numbers that we're getting?
Well, but it does look like that BNP FIC trading revenue number was, I mean, it was monster, 27%. That beats the U.S. average FIC trading revenue increase of 14%. So they are really standing out as a strong fixed income trading desk this year. Deutsche Bank's increase was only 11%. So still maybe more in line with the U.S. average. But BNP really does stand out.
But these are strong numbers. Broadly, these are really strong numbers.
And that's great. The stronger your numbers, the more we ask, are they sustainable, though, which is your point about the third quarter. And in terms of the US messaging that we had around that theme, I do remember David Solomon's it feels like ages ago, but probably just last week, wasn't it? But the message there was that there was some sustainability into this quarter from some of what they were at least delivering on the trading side of things. So we'll have to wait and see how that plays out. But that was certainly one of the themes, wasn't it? Better than expected on FIC for Deutsche Bank and for BNP. In terms of other companies that struck me as interesting, no change in guidance at Roche and no change in guidance at Nestle. I just thought for businesses that have so many headwinds, which they talk about, it's interesting.
Both of those two companies...
Tell me that's not the story.
I don't think that's the story. I think the story is FX. And the headwinds that these companies...
But isn't it interesting that they stick to guidance regardless of the FX headwind?
Yes.
So maybe we're both
But they know, so they're talking about the FX. They're sticking to guidance because they think that the FX is now in. so they can stick to guidance. They think that on a quarter-by-quarter basis, they can see some quite grim numbers coming forward, but it is reasonably sustainable. The numbers in both, ST Micro is exactly the same.
Yep.
These are really big numbers in terms of the top-line hit for an FX story that could, according to a lot of people, get worse from here. But these companies are plugging in steady-state numbers. But the FX market, if you talk to people, they're expecting a weaker dollar from here. So that's steady state. So yes, they are sticking to guidance.
But when we speak,
with a steady state
when
number.
we speak to Roche, then this is a really good question. Is you're sticking to guidance, but what are the assumptions that underline that guidance?
Exactly.
Well, a few of these companies did quantify the negative impact. From Nestle, they quantified it as a negative hit of 4.7% on their sales from FX headwinds, and then we had ST Micro saying that Q3, so the next quarter, gross margin would be hit 140 basis points. So there are some quantifying of the FX hits.
Roche is saying something. Roche has got some really big numbers, I think. We're going to talk to Thomas Shinecker soon. I want to quantify what he's saying. But he's saying they see a steady number, and they can stick to guidance with a steady number. Is that number going to be steady? Because that's not the picture we have when FX people sit next to us here.
Well, speaking of guidance, let's move on to the Mag 7 earnings of yesterday. And Alphabet raising their CapEx guidance by another $10 billion. They aim to spend $85 billion on CapEx in the year of 2025. And it was a beat across the board. Cloud revenue came in strong. Also, their Google search revenue came in strong as well. I know you want to note on their talent, what they're spending on to retain talent.
They have to spend enormous amounts of money to retain talent.
Yeah, and this comes up in R&D spend, it seems. The CFO flagging that part of the reason why the R&D spend went higher, because we had that story about Meta spending so big. So if Meta spends big, others
Everybody
in the sector
has to follow.
Didn't it feel? I listened to a bit of the call on this morning on the way in, and it felt like Alphabet feels trapped at the moment. It's getting quite a lot of business, but in order to satisfy that business, it's having to spend gargantuan amounts of money, and that's, I think, why the stock dipped initially.
Right after the
right off the bat, the stock it came back up as they started to quantify maybe what was happening on a top line basis in terms of the sales story, and the two maybe do meet. But nevertheless, the arms race feels ferocious at the moment.
Well, speaking of stocks dipping, Tesla did not have a good earnings release. Musk, the CEO, warning of rough quarters ahead. And it really, was the biggest quarterly drop in revenue in nearly a decade. So some of these numbers weren't necessarily what investors want to hear. They did have a line on tariff costs saying they increased to $300 million and will continue to increase over the near term. So that was their line on auto
So basically,
tariffs.
the credits have gone. Now this is a normal company, and they're really struggling. And at the same time, we're seeing EV sales coming under an awful lot of pressure. You can see that this morning in terms of the European car sales number dropping the most in 10 months, EV growth slowing. That's going to be a big problem. It's not just a big problem for Tesla, it's a big problem for all of the big European car
And you're
makers.
going to be speaking to one of them.
CFO, tomorrow morning I will be there in Wolfsburg. I'm making the trek to Wolfsburg via Berlin and the long train journey to get there. But we will, So I think there's a tariff story. We still don't know what's happening on the tariff front. We still don't know what's going to be happening with the European-US story there. We know what's going to happen with the Japanese story. But EV sales are dipping, and these companies continue to have to invest huge amounts of money.
That is planes, trains, and ending with automobiles then.
Great.
Excellent.
Very nice.
I like that. Let's move on to tariffs, because we've had some news flow there as well, haven't we? President Trump talking about, is this a new baseline for tariffs? Talking about 15%. The range of 15 to 50 is what he's discussing now, his latest rhetoric around what he calls reciprocal tariffs, of course. He talks about the EU-US talks being serious, and our own reporting and that of other media outlets suggests that 15% is something that we're aiming for. There's going to be a lot of focus on the detail if we do get a 15% deal. What does that include? Is that including tariffs that exist already between the two, which is, I know, a line that you picked up, Val, as important?
Exactly. It does seem like what was reported from the FT and what was reported by Bloomberg is that the EU is assuming that 15% is the total tariff number, not the incremental increase. And for them, that's the status quo. That's the 10% universal tariff plus the 4.3 average that they have.
And potentially, and if you look at the Japanese deal, maybe you don't. That includes the carve-outs as well. So that's the same number
for the
autos, that's the same number for pharmaceuticals.
Big assumptions in that.
I know there's huge assumptions being made, and we still don't know. I want to flag another trade deal, which is the India trade deal that the UK is going to be signing today, which I think is significant, and also just flags how difficult it is to get a deal done with India. Remember that the US has not done a deal with India.
It's the only one that hasn't really received the letter yet.
It's the kind of the major economy that really hasn't got anything done yet. So I think it's going to be... I'm interested to see when that gets signed a little later on today out of the UK, whether or not there is maybe some ideas about how you extrapolate that.
Meanwhile,
to the US.
the European delegation is in China trying to talk trade there, but that gets murky and difficult because they fall out over other things to do with support for Russia, of course. And there's been some early salvos for, you know, both sides setting out their stalls. It's not as if there's an expectation of any sort of deal making here or a big news reveal, but we have had some news lines around their different expectations, or maybe, and from the Chinese side about what they can come together on, I suppose. But this feels weirdly timed, doesn't it? But I think it's a marker in the sand based on the length of the decades-long trading relationship that just happened to fall in the middle of US-EU trade talks.
Yeah, and I guess a visit that was cut a day short as well from previous reporting. It does seem like the one thing they can agree on is the climate agenda. I know that's not necessarily what markets are focused on right now, but
yeah, climate, that feels like it's
ages away.
I know.
Behind us.
Behind us, but definitely in front of us. Let's talk about what we've got coming on the show. We should probably stop talking because we've got some great guests lined up. Lars Machenil, the BNP Paribas CFO, is going to be joining us very shortly. Nick Luff, RELX's CFO, is going to be joining us as well. Thomas Shinecker, the Roche CEO, is going to be joining us as well. And Charlie Nunn, the Lloyds Bank CEO, will be joining us. So there's an awful lot going on, and we're not done yet.
Yes, another conversation to point out. The UK Supreme Court has quashed the conviction of the former star trader Tom Hayes for rigging the LIBOR benchmark interest rate. We will speak to him, to Tom Hayes, later in this programme.
So BNP Paribas out with some stronger numbers this morning. The FIC numbers are sensationally strong. Lars Machenil is the CFO of BNP Paribas and joins us now. Lars, good morning. As I say, these are strong numbers. The FIC team has done really well. Fixed income trading, currency trading, definitely on the front foot in this quarter. The question we always like to ask is this sustainable? Because last quarter was an exceptional quarter. There was so much volatility in this market. And I'm wondering what the current quarter looks like versus the quarter you just reported on.
Yes, good morning, by the way. Pleasure to be with you. Listen, if you look at it, at BNP Paribas, we have a setup to basically serve all the kind of FIC products, right? And so what you see in the quarter that has happened, there was volatility, there were several demands, and particularly if you look at rates. Rates was really very strong, but also credit picked up over the quarter. So how will this continue? Listen, we have been having, quote unquote, record quarters one after the other. So we anticipate that the rhythm and demand will continue. Nevertheless, if you look at the overall growth for BNP Paribas in the second quarter, what we really step up are the other divisions, in particularly what we call CPBS, so our networks within the Eurozone. They will anticipate to be really stronger given the rates environment. And that's basically why we even mentioned that our full year profit will exceed 12.2 billion on that additional growth coming in the second quarter in the networks.
Where does the challenge lie, therefore? Which bit of the business needs a focus put on it, maybe a light shone on it with greater brightness, Lars? Is it the domestic retail network? Is it maybe actually getting more out of what you're seeing in terms of the wealth business? Where is the challenge next for you guys, if, as you say, you can sustain these kinds of numbers in trading?
Yes, so we anticipate in the three divisions, if you look at it, CIB, we are flying at high levels of profitability, and the idea is to continue to take market share in that activity. Then the other two that we have, so the networks, they will see a step up in the second half of the year on the back of the rates. I remind you that in France and in Belgium, where we operate, we typically have fixed rate loans. So basically, the pickup in rates or the evolution in rates, it takes time to crystallize. We see the pivot in the second quarter, so that will continue to grow in the second half of the year. And then the other one that for us is really a material growth engine is insurance and wealth management. So they were already strong, and we have been able to bolt on additional activities. So we bolted on the 1st of July, the AXA asset management activities. We are closing the deals with HSBC in wealth management in Germany. So yes, these are really activities where we are able to grow intrinsically very fast, and we are able to strengthen our setup.
Lars, good morning. So clearly the trading business that you've described, you think it's sustainable, has benefited from some of the volatility in markets. We know that some of that volatility has been driven by ongoing conversations and news flow surrounding tariffs. How much is this impacting on the consumers you serve, the businesses you serve? Do you see any read across? Do you have to take any provisions? Are you concerned about the outlook because of the tariff environment?
Today, the talks about tariffs are basically leading to uncertainty. So the impact we saw is rather a wait and see, and particularly in April. In April, corporates, they were waiting and seeing what to do. So that uncertainty, the good thing is that now tapers off. Yeah? If the consequence is that there will be a step up in tariffs, if this tariffs is like, I don't know what, 15%, it should be manageable. So if it's 15%, yes, there will be an impact on the activities, Europe, US. But if you look at the options that Europe has, the calibration, the step up in their own investments, that should normally compensate. So in our central scenario, we have taken up that there would be tariffs of, let's say, around 15%. So the main thing is that uncertainty tapers off. And then if it is something around these kind of levels, it should intrinsically be manageable. And that is basically what we see. But it's also a bit, when I talk to investors, what they see. I was a couple of weeks ago, I was in Asia, and they basically see that Europe is indeed having that kind of pickup, and they rebalance a bit their investments accordingly.
Can I ask you about returning cash to shareholders? You're painting quite a positive picture, Lars. You're talking about sustainability of some of the strength in the trading business. What is your policy around returning cash to shareholders at this point?
Yeah. Yes, so typically we have 50% return in cash, so 50% of earnings are returned back in cash. Normally we do this once a year after the full year results are certified. So typically in May of 26, we would be paying 50% over the earnings. However, given that our profitability is very profitable, our capital ratios are very profitable, we basically introduce, which is rather unique in a continental or Northern European environment, we introduce an interim dividend. So we will pay at the 30th of September, we will pay 50% of dividend on the earnings of the first half year.
Lars, I want to turn to what's going on in France. We know that there is a high debt to GDP, and France is lagging behind, at least on GDP growth numbers. If we're looking ahead to this year, are you concerned at all about domestic growth in France, maybe hampering your ability to grow?
Well, there's two things to that. We are a bank which we are a pan-European bank. Yeah? So the French activities are maybe 10% of our bottom line. So that is how you should read it. And therefore, for me, it's relevant to look at what Europe is going to do. And in Europe, we see a pickup. We see investment happening. We see restructuring happening. So from that point of view, it's fine. And then when it comes to the politics in France, there is not much I can say. What there is, France has to grasp with the fact that now the executive branch does not consist of one party, so they have to create coalitions, so that gives some volatility. But if you look at the underlying environment, it is basically positive. And again, for us as a pan-European bank, we see many elements driving a pickup.
Well, if you are viewing BNP as a pan-European bank, we have to talk about the ECB, who is meeting today, widely expected to hold interest rates. But we are pricing in more cuts throughout the remainder of the year. Given this overhang of trade uncertainty, do you think that potential ECB cuts could be something that weighs on net income through the remainder of the year?
Listen, the main thing for us is basically that the yield curve is in normal territory. Yeah, so it's a steepening yield curve. That's important. The other thing is that if you look in Europe, we are hovering around an interest rate which basically makes sense. So that means that the ECB considers that inflation is under control, which is an important element, and so there is some leeway if there would be whatever kind of evolution that the ECB could interact. So from that point of view, we consider that in Europe, the interest rates environment is basically, and the inflation environment is basically handled. There is some room to maneuver, but intrinsically, the important thing is that we have a normally sloped yield curve, which is for the activities what we need.
OK, inflation is handled. Thank you very much, Lars. Great to speak to you. Lars Machenil, the CFO of BNP Paribas. Coming up on the programme, will July be the calm before the rate-cutting storm for the ECB? Well, will they need to? What will happen on trade? So many questions go into answering that question. We'll be live from Frankfurt to preview Christine Lagarde's decision later in the day. That's next. This is Bloomberg.
23 minutes past the hour. Let's talk about what you need to know this Thursday morning. More than 100 aid agencies are now urging Israel to let more food supplies into Gaza, warning that, quote, mass starvation is now spreading. Meanwhile, Hamas says it's handed over its response, drafted in cooperation with other Palestinian groups, to a ceasefire proposal put forward by mediators. President Trump has signed executive orders to boost AI developments in the United States by loosening regulations and growing energy supplies for data centers. The measures will address energy and permit issues for infrastructure, as well as promotion of AI exports.
America is the country that started the AI race. And as President of the United States, I'm here today to declare that America is going to win it. We're going to work hard. We're going to win it.
Staying with President Trump, he is saying that he is planning to visit the Federal Reserve later today to tour the construction site he's criticised Powell for mishandling. In recent days, Trump has said that he does not plan to fire Jay Powell before the end of his term. But the US president has not fully closed the door on removing him over his handling over the $2.5 billion renovation project. I can't quite work out whether or not this is going to diffuse the situation or make it worse.
Maybe he'll be impressed by the building works.
Yes. He'll say, that's a lot of marble. That must be expensive.
He's a real estate guy. I'm sure he's got...
Yes, and he appreciates some marble, we know.
Yeah.
So, we'll see what he concludes on that visit. Talking of central banks, Lizzie Burden is visiting the European Central Bank, not with the same backstory. But the ECB is set to leave interest rates untouched at 2%. Let's get to Lizzie Burden to find out what is on her mind outside the ECB headquarters in Frankfurt. So trade is everywhere. Trade headlines are everywhere, Lizzie. Has that changed the thinking at all around what the ECB might do or say today?
Well, Anna, whether or not Washington and Brussels can get a trade deal could decide whether today is the start of a hold or the end to rate cuts from the ECB. Of course, you've noted our reporting suggests that that trade deal is just around the corner, a 15% deal following in the footsteps of Japan. And for some economists like Berenberg and RBC, that would suggest that you don't need to cut any more this year. But I was speaking to our economists last night at Bloomberg Economics, and they say that even with a 15% deal, that's higher than the 10% that was in the ECB's baseline forecast in June when they suggested that they would need another cut. And then you've got to layer on top of that the sectoral levies, so they would still see cuts in September and December. And I asked them, what about if you get a no-deal scenario? Because that's worse than the most severe scenario that the ECB forecast back in June. And they said, actually, interestingly, it wouldn't necessarily change things much because you would have to counter the disinflationary impact of a 30% American tariff with the retaliation and the inflationary impact of the Brussels retaliation. So you could still end up with cuts in September and December. In any case, all I'm trying to tell you is there are a lot of scenarios on the table here. By September, hopefully, and I say this every meeting I know, but hopefully we'll have a bit more clarity when it comes to trade. We'll definitely have more data, and most importantly, perhaps, we'll have the updated forecasts. And that is why, in our survey, all but 2 economists expect a hold from the ECB today.
Yeah, we can definitely promise there'll be more trade news by the next meeting. Whether we will get to the end of that story, who knows? Lizzie, thank you. Bloomberg's Lizzie Burden with us from the ECB. More from her later. Coming up, we'll be back to the earnings conversations. The RELX CFO, Nick Luff, will be joining us for an exclusive conversation. This business, very attached to the AI theme, of course. We'll get into that. This is Bloomberg.
"30 minutes to go until the market open this Thursday morning." You've got a kind of top-down trade story which you need to fold into the figures that we are going to be seeing posted, and also the bottom-up earnings picture which needs to go in as well. But broadly at the moment, it is a very, very positive open that we are anticipating here in Europe this morning. There is this expectation maybe that a trade deal is about to be announced, plus also fold in some of the good corporate numbers this morning we're seeing, particularly from the banking sector, which looks really good this morning, Val.
Yeah, let's flip over and see how the fixed income open is faring here in Europe. And it is feeling the risk on move. We're having bond yields higher across the curve in Germany and France. Maybe this is also a bit of a catch-up trade as well. We know the U.S. session had a pretty decent session when it came to the S&P 500 close. Its second best session this month. So maybe those record highs. It's putting the bond market rally on hold for a moment.
OK, let's get back to the earnings stories then, Val. And we've had numbers out of RELX, the analytics data business, reporting numbers. Operating profit looks entirely in line with analysts' expectations. I'm sure there's much more to say, though, on this subject. So let's bring into the conversation Nick Luff, who's the CFO of RELX, and with us to talk about the earnings this morning. Nick, really nice to see you, as ever. You've said this morning in your statement that there is momentum, positive momentum across the group. Can you tell us a little more about, from risk to legal, scientific exhibitions, where are you seeing that momentum coming through?
Yeah, morning, Anna. Yeah, no, absolutely. There's good momentum right across the group. Across all our businesses, we're seeing positive momentum as the growth rates are picking up over time. Our biggest business, risk, is growing really well at 8%, and that's continued in this first half. And then on the legal, had a step up in growth to 9%. And it's there, and together with STM, our scientific business, where generative AI is really coming into play. So we're actually been rolling out generative AI products for a couple of years now. We're seeing really good momentum in that. The pace of product introduction is good, the adoption is good, and that's what's really driving the overall uptake in growth that we're seeing.
Yes, lots to ask you about AI, no doubt, as the conversation goes on. But I want to ask you about FX exposure, because this has been something of a theme coming through in a number of corporates, in particular businesses listed and that do their accounting in non-dollars, but sell a lot in dollars. And you do a lot of business. I think 60% of your revenues come from the United States, Nick. So how are you facing up against a weaker dollar? How is that impacting the business, and what can you do to counter it?
Yeah, we do earn a significant portion of our earnings in dollars. And as you say, we do report the numbers in sterling. But I think the focus of our investors really is on what we describe as the constant currency numbers. And that's where you see the underlying performance coming through, where the growth coming through. And we present all our percentage growth rates, excluding the effect of currency. And people tend to look through that over time. And the business is pretty well balanced as far as currency is concerned. And our investors understand that when they buy into RELX, they're buying a dollar-earning business.
Nick, I want to turn to the AI theme of your business here. We have heard from many U.S. tech companies talking about the talent war for AI really costing a lot more than they expected. What's your business like in terms of how much you're paying to retain talent, especially when it comes to AI?
Yeah, no, obviously attracting the right talent with the right skill set, and we need experts in the markets we're serving. We need experts in the technology. We need experts in generative AI, data scientists, etc. And of course, we have to offer competitive packages. We can recruit globally, and we can hire that talent wherever we can find it in the world. And I think the key thing about RELX is that we have what you call use of technology for a purpose, and people are really proud of what the company does. We're out there advancing science, improving the rule of law, improving healthcare outcomes, preventing fraud. These are purposes that people can really get behind. So not only do we offer a good environment for people to work in, and offer competitive packages, of course, to do that, but it's actually something people really are proud of working for the company, and that's how we attract and retain the talent we need.
And then on the AI models you're building more broadly, is it something that you're, I guess, having a difficulty keeping up with competitors who are also in the AI application space? What's the competitiveness like?
Oh yeah, absolutely. There's a lot going on. Lots of companies doing different things, but I think we're right at the cutting edge of that. As you say, we're users of these large language models, and so we're really always looking to. We've had from the outset a multi-model, use the best model for a particular application approach. We're constantly evaluating the large language models as they evolve and leapfrog each other, and change which one we're using in our products, and that's really coming through in the quality of as we measure customer reaction and customer acceptance of the products. You can see that really coming through, and so I think we obviously have to keep working at that and keep evolving as we see new models emerge and new capability emerge. But I think we're right up there as far as companies applying these models to our markets are concerned.
Nick, just picking up on that, how much benefit are you getting is it allowing you to maybe take headcount out elsewhere? Can you just give us a sort of sense of the effect of AI thus far in terms of the business and kind of how much more is still to come?
Yeah, look, the most important thing about AI, generative AI, as far as we're concerned, is application in our products. So we're using it combined with our content sets, combined with our technology, to help lawyers, to help scientists, to help medical professionals make better decisions, become more efficient, and that's where generative AI really matters to us in terms of the product application on the revenue side. We are also using it internally, of course, to make ourselves more efficient. But that's really about enabling us to do things that we perhaps couldn't have done at the scale we can now do them. The volumes you can now handle of text, the efficiency in coding, so the amount of output you can get for the same number of people. And so really it's about doing more with the resources we've got, and the efficiencies that are coming, we're using to drive the business growth faster.
Can I just come back to some of the principal and emerging risks as you list them in the press release this morning? Barely a day goes by, Nick, without some sort of a data breach being headline news. Obviously, the hack on Microsoft is the one that we've been focusing on over the last few days. You've obviously got recent experience of this as well. How big a challenge is this right now? How is the landscape changing? Because it does seem as if just the cadence of these stories seems to be getting bigger and bigger. And considering this is a key part of your business, what you do in terms of integrating data sets to allow personal data to be analysed and used more effectively, how big a risk does this represent to the business right now? Is that a growing risk, or is it reasonably stable?
Yeah, look, it's absolutely key to our business. We have a lot of data. Some of it's not sensitive, but some of it is sensitive data. And so how we collect that data, how we store that data, how we protect that data, how we make sure that it's if anyone does get hold of some of it, it's not very extensive and so on, is absolutely key to what we do. And we spend a lot of time on that. The board spends a lot of time on that. The management team spend a lot of time on that. And it's actually at the heart. You really have to build it into your day-to-day operations and really how you operate. You can never be complacent, and as you say, the environment out there continues to be challenging. But actually, we feel we've got a good position and of managing that well in a difficult and challenging environment as far as cybersecurity is concerned. Absolutely.
Nick, can I ask you, you've talked about how you benefit from large language models and use them, and your clients then benefit from them. But there is another part of the relationship with large language models I wanted to ask you about. We're seeing a lot of legal cases at the moment of those who own data, and you own a lot of data, suggesting that large language models have been trained on their data without permission, and those arguments are going to court. And there's a lot of conversation about whether fair use will be justification for the LLMs for doing that. Is this something you're watching carefully? Would you expect to see any kind of resolution? Is RELX, have you been targeted by LLMs in this way?
Well, obviously, there's an evolving regulatory landscape around LLMs and how they use content and data, and intellectual property law has been evolving over many years. And that's important to us and protecting our content and data. But we have agreements in place with all of the major large language model providers. And we think we're the best users of our content and data, applying the large language models to them and doing that for the benefit of our customers. So our agreements don't allow them to use our content in ways that we wouldn't want them to.
Nick, great to catch up. Thanks for spending some time with us this morning. Really appreciate you updating us and our audience on what is happening with the business. Nick Luff, RELX's CFO. Next, we are going to be turning to what is happening in the pharmaceutical space. Roche's first half earnings beating estimates, helped by sales of its asthma and eye medicines. We'll be speaking to the company's CEO next. This is Bloomberg. Welcome back to the opening trade. Let's talk about some of the corporate news that we've had out this morning. Roche, the giant pharma stock out of Switzerland, out with numbers. Stock rallied yesterday into the figures, up by 2.83%. That was the percentage performance yesterday. This morning, the company has come out and beaten on profits. We are looking for clearly some updates on what is happening with the pipeline, because that is the big focus for investors right now. And we're anticipating some fairly big updates to come through from this company. We also probably need to talk about what is happening with the currency story as well. We'll come on to all of that in just a moment, because we are joined by Thomas Shinecker. He is the CEO of Roche and has given us some time this morning. Good morning, Thomas. So the numbers look really good. Certainly the stock, I think, rose nicely into the figures. To be honest, I'm looking at your guidance this morning and where you are now at the half-year level, and I'm just wondering whether or not actually we should have seen a guidance upgrade today, because actually, in terms of where we are, it looks like we're ahead of where we're expected to be at the full year, at the half-year point. So you're doing really well in terms of tracking towards those targets. Any reason why you decided not to upgrade guidance and give us a slightly better number for the full year?
Well, thank you very much for inviting me. And yeah, our numbers are really great at half year. We've been growing 7% in sales and even 12% in EPS. And this is really driven by the pharmaceuticals division that is growing 10%. And in Q2, we even saw an acceleration to 11% for pharmaceuticals. Now, of course, you can ask with those numbers, why do we not increase the guidance? We also know that there are, I would say, a lot of geopolitical uncertainties these days. And we wanted to see how this plays out over the next couple of months. And then we can look at this at Q3.
OK. Fair enough. I think we're all very, very aware of those geopolitical uncertainties, and there seem to be many of them, mainly relating to the United States, but there's a few other issues as well. One of those factors, I suspect, is the currency story. And I have to say, looking through your numbers, there is a significant factor coming from currencies right now. You are guiding on a constant currency basis going forward from here. How confident are you, though, that we are going to see a constant currency going forward from here when it comes to the Swiss franc?
Yeah, we've always guided in constant exchange rates simply because companies cannot influence currency fluctuations. What I can say is that as a company, we're well positioned because we actually have a good distribution of our costs around the world. And with that, we have a good natural hedge from that perspective. So I think we're in a very good position as a company, and we'll continue to focus on the things that we can definitely influence. And this is sales and earnings and being very cost efficient. And I think we've done a great job in that in the first half of the year. And I'm very comfortable that we will do as well also in the second half of the year.
Thomas, I want to ask a question more directly on tariffs. President Donald Trump has threatened pharmaceutical tariffs at various times, but the recent threat was that they could come in as soon as August. Is your company taking any preemptive measures in order to maybe perhaps front run these tariffs?
Yeah, I mean, this has been a discussion since the beginning of the year. And as a company, we always do scenario planning, and we've done that at that time. We've moved around inventories so that we have a lot of stock in place in the United States, in Europe, but also in China, so we can mitigate some of this impact. We also did a deep analysis on, where do we produce the different medicines and what can we shift around. And here we're extremely well positioned. We have 13 manufacturing sites already in the United States. We could just ramp up manufacturing of key medicines in the United States because we had free capacity because of all the innovation that we did to make our processes and our manufacturing more efficient. And there was only one medicine where we had to do a tech transfer. And we started that already in the beginning of the year. And we should be finished with that by the end of the year. And then we will need to wait for regulatory approval of that medicine for that manufacturing site in the United States. And we're in exchange with the regulatory bodies on that. And we hope that the US government will expedite that. So overall, I think as a company, we're very well positioned. We also pledged 50 billion investment into more manufacturing and research and development in the United States. So I think we're doing what is asked is to produce the medicines in the US that are used by Americans.
Thomas, you mentioned scenario planning there. What kind of numbers on tariffs are included in those scenario? We've heard from President Trump, he's threatened as high as 200%. Is that something that you're perhaps preparing for?
So, when you look at scenarios in these times, I think we had more than 20 scenarios. So I think it would be too much to go into the details of all of that. But I can tell you we are well prepared. And that's why we've ramped up manufacturing already in the United States. We've transferred inventories, and we did the tech transfer of the one remaining medicine that we had never produced in the US, and we had to do a tech transfer for. So I think compared to many other companies, we're super well prepared.
Okay, yes, so it sounds as if you are taking quite a lot of action based on that pressure from the US, Thomas. Let me ask you about something else you've mentioned that is US related. You've said this morning you're considering doing more direct-to-patient supply of medicines, so trying to cut out suppliers in the middle. How much difference do you think that will make to end consumers, and how much of your portfolio can you supply that way?
So in the United States, actually 50% of all the profits go to so-called middlemen or middlewomen, these PBMs. And actually, they don't carry any of the risk. As a pharmaceutical company being innovative, you have to take a lot of risk if you want to develop a new medicine. And I think it's just not okay that so-called middlemen take 50% of the profit. So if the United States wants to reduce prices, let us go direct, and we can cut out 50% of the prices. And we can do that across the portfolio.
Thank you very much, Thomas. Thanks for joining us. Thomas Shinecker, the CEO of Roche. Let's go from that one earnings story that the market will be digesting this morning to the broader market themes. Mark Cudmore, our Markets Live executive editor, joins us right now. And Mark, good morning. European markets seem to have got themselves quite excited about the prospect of a 15% deal. We had this as the main theme yesterday. It continues to be the main theme. That and some maintaining guidance from corporates this morning. Is that underpinning sentiment, do you think?
Yeah, absolutely. Obviously, the trade deal headlines are kind of very positive. And we discussed this yesterday, that it seems crazy, but traders probably have to skew positively into the deadline next week, even if you think tariffs will ultimately be damaging. That's over the much longer term. That the headline risk in the short term is for more deals to be announced until we get to that August 1st deadline. And it looks like lots of these deals will be announced because we've now got a template of around that 15% level. Ultimately, that's super damaging and really bad, and particularly for US economy and US stocks. But that's not the theme we're going to trade now. Helping the story also, not just earnings, but the fact dollar weakness is also helping as well. And the PBOC encouraged that with the much lower fixing overnight too.
Does the dollar continue to go down? This is the theme throughout some of the corporates that we're watching this morning.
Do you know what's interesting is that, as you know, I very much believe in longer-term dollar depreciation in the next couple of years and think there's a long way to go. Given the number of catalysts we've had actually over the last 24 hours, it's actually notable that dollar's not even weaker. You've got the PBOC encouraging it, you've got the trade deal headlines, which are positive for other currencies. The dollar-yen trade is back because the BOJ are likely to have to hike rates, or at least open the door to hiking rates.
People are chasing US markets? Do you think there's some flow?
No, not particularly. I mean, you're seeing US stocks are still underperforming on a global basis, around the rest of the world. More of the benefit from the trade deals is going elsewhere. Sure, we're getting the meme excitement in the US. But so you'd think that actually, everything in the last 24 hours is lining up for dollar weakness, and we're not seeing dramatic weakness, which probably means that people are struggling to push a little bit further in the short term.
You mentioned the meme stock frenzy that's been going on. GoPro, Krispy Kreme, Kohl's, all of these names seeming to catch a huge amount of attention. Call options are surging on these names. What do you make of that?
I mean, look, it's not great for kind of the structure of the market in terms it makes it a bit more flawed because these are highly volatile names, and that kind of leads to spiraling kind of losses in other assets. So I think that this makes it fragile, but I think people are mistaken when they see meme stocks. It's time to go short. It's not a straight line as that. As we all know, the best thing to trade is going long a bubble in the early stages. When you spot a bubble, you get long. You don't fight a bubble. And so I think when we see meme stocks, we see some of that exuberance, and you don't fight it immediately. It's a warning sign for much longer term.
Meme stocks, one thing we're watching stateside. Tech earnings, something else we're watching stateside. And even for macro tourists, this becomes interesting when AI is such a huge theme, of course. And we've started to see big capex numbers coming through. This certainly the theme out, the alphabet numbers. How is this going to feed into market sentiment, do you think?
Look, from what I've seen, the alphabet numbers, probably haven't had time to go through in detail. This is really positive. I mean, it shows that the AI theme is durable, and by the sounds things of Alphabet, what they're really pointing towards is the swivel to agentic AI next year. And that might be the whole next leg of this AI theme. So I think that maybe is durable. It was interesting because we had the clash of the Tesla and Alphabet earnings. And going back to the meme point, Tesla's vulnerability is not great for meme stocks today because it's the same sector that invest in both Tesla and meme stocks. Tesla is a meme stock for many regards. But I thought the Alphabet stuff is really, really positive on a structural thing on the AI theme. So again, I think the macro tailwinds are quite positive for this market, despite the excess exuberance we're seeing in meme stocks.
Okay. Positive news. I'm slightly, okay. Mark, positive on the market this morning. It'll be interesting to see what happens next. Mark Cobmore, rest of the MLIV team, fantastic work going on at the moment. First thing you need to read when you get up in the morning, MLIV Go on your Bloomberg or your phone or wherever else you're getting that great stuff. I'm going to go. I've got to go to Berlin and then to Wolfsburg. The Volkswagen CFO, I'll be in conversation with him tomorrow morning. Look, I think all the themes that are relevant this morning are going to come into that conversation as well. You've got what is happening with the EV trade. You've just been talking about what's been happening with Tesla. You've got what is happening with the FX story. You've got what's happening with the trade story. All of that is going to come in. And they've got to build some cars as well. While they're at it as well.
Yes, absolutely. So all of the themes of the moment in the earnings story then coming through there. So, Guy off to do that. Val and I were here for the market open. And Val, so the overall picture looks really positive, but there's a real divergence from the companies that have reported this morning as to where analysts see them going and where the market sees them going. So we'll see how much those individual corporate themes cut through the tariff optimism.
Yeah, exactly. Which ones, I guess, are more tilted towards the positivity around tariffs or around earnings? We have two of those things pushing the European market higher this morning.
Coming up on the programme, then, we'll bring you that opening trade. Futures are pointing higher this morning. This is Bloomberg. Welcome back. This is the opening trade. A few minutes to go then until we get that opening trade for European equity markets. Let's have a look at the setup through yesterday's session, through the full picture of the United States trading day and what that means for us here in Europe. You can see that where we see the blue continuing to the far side of this chart, that is the US going it alone. And that going it alone resulted in some stock gains. And so as a result of that, we might need to, even if nothing else had happened, factor in some more positivity to European markets. On top of that, you can layer some building optimism around the tariff story. So our reporting suggests that the Europeans are homing in on 15% as some kind of baseline tariff, and even the suggestion in the reporting that could cover some pretty high value and important sectors such as autos, for example, and maybe there's some tweaking to what we've got on steel and aluminium. Anyway, all of that adds up to something pretty positive for Europe, and so futures are pointing higher. DAX futures up by just over 1%, Euro Stoxx 50 futures up by 1%, and of course we know the story around the FTSE, we know the story at least around the UK and the tariffs. So less movement there, up by around 0.4%. Val, we've got a lot of corporate reporting this morning, that and some other factors driving individual stock names.
Yeah, earnings and tariffs on the mind at the market open in just a moment's time. Key here will be how bank stocks perform at the open. We've heard from both Deutsche Bank and BNP coming in with beats on fixed income trading, matching some of those beats from their U.S. peers. Also, Nestle for consumer products, they had a beat on sales fueled by price hikes. So a little bit of tariff news in there as well. And then finally, pharma will be looking how Roche prices act at the open. They had a beat as well. Anna.
Yeah, absolutely. A lot of other corporates reporting, Lloyds Banking Group, BT, ITV, lots in the UK. So we'll watch out for those as well, Val. And interesting to see after yesterday's gains in the auto space, can that sector factor in more positivity around the trade narrative, the tariff narrative? Let's look at where we are then at the start of this trading day, Thursday morning. How do European equity markets open up? Well, we only have the FTSE 100 to go on, and that's not going to be the pace setter today. If the excitement is around an EU-US trade deal, then we don't look to the FTSE necessarily to show us the limit of our expectations there. Stock 600 up by 0.25%. The IBEX certainly doing a good job of factoring in some of that tariff optimism, up by 0.9%. Could this be a day, Val, where it takes a little time for the CAC and the DAX to open if there is a building excitement and a building expectation of some kind of tariff story, a positive tariff story coming between these two trading partners across the Atlantic. Of course, it is ECB day, and no doubt those in Frankfurt will be keenly awaiting any news flow around tariffs, because that might make their conversations around rate setting in the second half of this year easier or more difficult. Anyway, let's have a look at early days as we wait for the DAX and the CAC to open. What does the sector picture look like? This might be an evolving story over the next 5 minutes, Val.
Yeah, that's right, Anna. Well, it does look like from the sector picture, it is quite positive. We have all but two sectors in the green this morning. At the top of the basket, Anna, is autos. So we are reacting positively still from the read-through from the latest news on tariffs that the EU is assuming a 15% baseline in their framework. Also, banks at the top of the basket, Anna, as well. That sector is up, now 1.3%. Must have a new stock that has opened. We've had a slew of strong banking results coming out this morning from Deutsche Bank and from BNP. Also, some other sectors at the top, basic resources performing well this morning. That's lifting the FTSE as well, Anna.
Yeah, absolutely. So it very much makes sense that we've got the two themes of the morning, earnings and tariffs, lifting those two sectors, doesn't it? So as you point out, the banking sector is doing really well this morning. BNP Paribas is one of those stocks in there, up by 2.6%. Deutsche Bank is also higher this morning, up by around 4.5%. So that positivity around the FIC trading story, something that's really played out well for these businesses in that most recent quarter, and that seems to be something that's supporting their earnings. And yeah, we got a quick answer, didn't we, to that question of whether autos can once again provide some upside. I mean, some of these, Stellantis was up by an incredible amount in yesterday's session, by nearly 10%. And yet we have another day where autos and parts can go higher, just up by 0.9% for the sector. VW is up by 1.3%, so that's something that Guy will be keeping in mind as he makes his way over to Wolfsburg for that conversation. Food, beverage and tobacco, I'm really drawn to the negativity, though, there. And yes, as expected, that had to be a heavyweight because the sector as a whole is down by a substantial amount. It's down by 1.4%, and Nestle is the big player in the mix there. That particular stock is down by 4.4% on the back of their numbers.
So a mixed picture, at least when it comes to some earnings being on the down foot, with Nestle, as you mentioned, in the red after they did come out with a beat in sales, but it was fueled by those price hikes. And then on the upside, Deutsche Bank climbing, as I'm looking at the movers, up now 4.5%. BNP is not too far behind at 2.5%. Joining us now is Claudia Panseri, France's CIO at UBS's Wealth Management. It's been a busy morning, Claudia, of earnings and tariff news. What do you take of the positivity we're having in this European session?
Good morning. The first positive is if all the news flow around the tariff. Everyone was expecting a 30% tariff. We may come up with 15%. That is a big positive versus expectation, but still 15% look quite high. Secondly, I think in terms of the earnings season, people were expecting a lot of downside. It's a bit mixed, but we still see some companies being able, especially in US, to deliver very strong results. And so probably valuation are less questionable now.
You're mentioning results out of the U.S. We did have some pretty strong results from Alphabet in both their cloud business, their Google revenue from their ad business, as well as an increase in CapEx. Claudia, is the AI trade a main part of how you're viewing markets at the moment?
We are still very positive on everything which is linked to AI. And we currently have seen, even yesterday, still announcing a lot of CapEx spending, which also very supportive for the semiconductor sector. People were questioning if after 2 years of good performance, valuation behind, monetization and earnings could keep going. And we currently see that the trend is still there. We also see from a macro point of view that there is a lot of investment. Trump is announcing a big investment in US to sustain the AI. So there are plenty of positive news still there. It's true, valuation is not cheap. But we know that we need to expect more return on equity to finalize this trend and to see where this trend can go. But we are still very positive. It's one of our main call since last year, and we are keep buying tech stocks more selectively than we were doing before, but we are still positive on the segment.
Claudia, good morning. From tech, I want to go back to the banking sector because this is a big theme of the morning. Some real positive statements coming from companies around what they've managed to deliver on FIC revenue, for example. If, as an investor, are you assuming that the rest of this year, the second half, is as volatile as the first half? Because that seems to be one of the big drivers of the strong performance for the banking sector. And yet it seems quite difficult to make that assumption. So how do you look at the outlook for the banking sector?
So I think there are two different trends. There is one trend which is in US, where the banking sector has been lagging the overall market. Performance was good, but not outperforming the overall index. And we moved recently positive ahead of the earnings season. And we have seen that companies are still surprising on the upside. Net margins are positive. And so there is a lot of activity, even if the M&A activity has been quiet in the first half. Then you have the European one, which has been one of the best performer, a sector on which you didn't have a risk of tariff, a sector which has been benefiting from lower interest rate because the default rate remained low. And the performance has been extremely good, also because we have been some particularly story with some Italian banks, but also relative to this M&A process, which everyone was expecting. And so in the European banks have been performing particularly well. Now, should we expect more performance in second half? Probably not. The results are good, but interest rates are falling. So the capacity to, let's say, to generate additional return on equity will be lower than what we have seen over the last 12 months. So probably a better position in US banks relative to the European ones.
OK, so that's the banking sector. I want to ask you about the broad theme that's driving markets right now, Claudia, and that's optimism around a trade deal between Europe and the United States. What careful language or enthusiasm would you offer around a rate of 15%? If we get a sort of baseline rate of 15% that maybe includes some of the sectoral, some of the areas we might have seen sectoral tariffs or have seen sectoral tariffs, how good or bad would that be for Europe?
So I think overall 15% is a good news because we were expecting 13%. So the market was expecting, we were rather thinking about a better tariff for Europe than many people were speculating about. But it's still 15%, and so we need to understand what's going on with the pharma sector and with the auto sector. We will keep 25% of the auto sector because this is also very important for Germany particularly. We have seen yesterday and today the auto sector bouncing back, but the risk is still there. On the overall market, I think the sector which are not exporting, which are less impacted, there is still some upside, but remain, even in that case, quite limited. We are tactically more cautious on European stocks rather than US stocks, just because performance has been strong. There is a lot of positive which is already integrated. And please keep in mind that on the top of the 15% of the tariff, we also have a strong appreciation of the euro. The euro has been reappreciated quite a lot since the beginning of the year, and that should impact the companies which are exporting on the top of the tariff.
Claudia, you mentioned that you're cautious on European markets and more positive on U.S. markets. With that backdrop, what do you make of this resurgence of meme stock mania, the surge in retail volumes, call options being traded? Does that make you does that make you maybe nervous about these all-time highs that the S&P 500 has reached every day this week, excuse me?
I mean, the market has been very resilient. What we are nervous about is the peak in volatility. So you always know that after a strong market rebound, you have a pause. We didn't have this pause. The market is up more than 20% since the lows of April. So we may have a pause, but and probably even a small correction. But the economy, the US economy, is really resilient. And we still have some rate cuts to come. So we are not expecting a huge drop. We just expect more volatility, a bit of consolidation. But for us, will be an entry point for all the clients which are not exposed yet or enough to the US market. There is a resilient in the earnings, resilient in the growth, and still the Fed has to cut.
Okay, yes, I was going to ask you about the Fed. I know that President Trump, we understand President Trump's going to be touring the Federal Reserve later to view the building work. He's had much to say on that subject, of course, and the future of Jerome Powell. You still are expecting cuts. What basis, what do you base those expectations on, Claudia?
So we are expecting the first cut coming in September, 25 basis points, and then another 50 basis points by the end of the year. We are a bit above consensus because consensus is now only expecting 50 basis point rate cut by December. And the reason is that we are expecting a slowdown in the economy. No, we are not expecting recession, but a slowdown in the second half of the year. A slowdown which is driven by the rising impact on consumer of tariff, but also a slowdown which is due to the fact that interest rates are still in restrictive zone. So you have more than 4%, and the data is slowing down. The employment market, unemployment is still very low, but when you look into other variables, we see a slowdown. So that should bring the Fed to cut the interest rate in September, starting with 25 basis points, and then 50 basis points by the end of the year.
OK, thank you very much, Claudia. Thanks for joining us. Claudia Panseri, the France CIO at UBS Wealth Management. Let's look at the core six, and we know that Nestle is one of the stocks on the move there, down by more than 3% for the food giant. Nestle is conducting a strategic review of its struggling vitamin brands, which may result in divestment. That's just one of the things to come out from the earnings story around Nestle this morning. We have Schneider Electric higher, ASML higher, Ferrari higher, LVMH a little on the back foot. We had numbers from Montclair, waiting for the numbers out of LVMH, of course. Let's get a rundown of some of the individual stocks that are moving this morning. Chloe Melly has an update. And Chloe, we've seen some big moves in the banking sector.
Yes, indeed, Anna. Good morning. So, yeah, as you can see, a wall of green this morning across that European banking sector. We have got really good earnings this morning from Deutsche Bank and BNP. Their fixed income performance was particularly good. That follows in the footsteps of what Wall Street banks have been saying, and the volatility in the second quarter boosted that fixed income segment. Lloyds also beat estimates. That's on the back of higher interest rates that stayed higher than it was expected, throughout the last few months, and that boosted the shares this morning. But Deutsche Bank and BNP particularly high this morning. Moving on to Nestle. So as you mentioned, Nestle is down this morning. The sales did increase, but it was off the back of price increases rather than volume increases, and volumes are still very weak, and that is feeding into the strategic review for the vitamins business, which might lead to a potential divestment, and that is making the shares go a little bit down this morning on the back of that. Moving on, we have got Reckitt. So Reckitt is actually up by quite a bit this morning, 8%. It announced a £1 billion buyback, and it's also raised its revenue forecast. So the investors are reacting very positively to that for Reckitt this morning. And then finally, we have ST Micro. So ST Micro, chip maker, it posted a surprise loss that's due to restructuring charges, and it also flagged weakness in the car end market. So it said that there was continued weakness there, and that is dragging the shares down almost 12% this morning for that chip maker.
Thanks very much, Chloe. Chloe Melly with the latest on the movers from our equities team, of course. And Val, just taking a step back and looking, now we've got the full complement of all the European markets open. So the DAX is up by 1%, the CAC 40 up by 0.5%. So perhaps, not quite living up to the futures picture and the sort of optimism we were expecting there. It is interesting that autos can once again stage a strong day based on the expectation, the hope, perhaps we should call it, that we get a favourable tariff for that sector. Because this is a sector that's already tariffed. There's already a sectoral tariff in place. And so if we saw that coming down to 15%, as some of our reporting has suggested, that would be perhaps a positive.
Yeah, we know we hear from Volkswagen as well tomorrow with maybe an update on how they're faring with the tariffs. But it's been two back-to-back days of pretty solid gains for these German car makers. BMW up 1.6, Mercedes up 1.5. So decent day for the autos, and also for the earnings story with those banks really lifting the index this morning.
Yeah, absolutely. Deutsche Bank up by more than 5%, BNP Paribas up by more than 2%. So both of those businesses, stories that we've covered, and fixed strength seems to be a feature of both of those. Now, we're just getting the PMI data coming through for France, Valerie, and the manufacturing number has come in a little weaker than expected, but it is a step up on the prior number. And the services number comes in a little stronger than expected, a little bit of a step up on the prior month. So a bit of improvement sequentially, perhaps here, but certainly not blowing the lights out.
Yeah, I think you're right to note that it has been a sequential improvement because last month we really saw a decent recovery, not just in France, but in Germany, in the broader Eurozone numbers as well. So that beat, a slight beat when it comes to French services, maybe foreshadowing what we're going to get from Germany in 15 minutes time, where we could see services enter an expansion territory that's above 50. But for now, it seems like the euro move on the euro is pretty contained, maybe a teeny tiny nudge higher. But we await the German numbers at 8:30 and the broader Eurozone numbers at 9.
Yeah, and if you look at the composite number, the jump up, the outperformance versus estimates looks bigger than if you look at just the manufacturing and services. So clearly something in the maths there. But interesting to note, we're not seeing too much movement, a bit of movement in the euro, as Val points out. Coming up on the programme then, European banks snatched the spotlight today with a raft of earnings, including the beat from Deutsche Bank. We'll dive into the results next. This is Bloomberg. Welcome back. This is the opening trade. We are 19 minutes into our trading day this Thursday, the 24th of July, and European equity markets on the rise. And part of the story, part of the optimism is trade tariff expectations, and part of it is earnings, and in particular from the banking sector. Deutsche Bank shares are on the rise this morning. Fixed income traders joined Wall Street peers in reaping the profits from volatility following the US administration's tariff announcements. Deutsche Bank CFO James von Moltke spoke to Bloomberg's Oliver Crook a little earlier.
Well, FX was actually very strong. It was probably the strongest point, and macro generally, so rates as well. Although it was a complex quarter given the way it started. Credit was a little tougher in the environment, for sure. Our performance we're really happy with, a very strong finish to the quarter. And you have to remember in all our results that foreign exchange translation is a burden and a benefit for some of our competitors across the Atlantic.
And a strong finish to the quarter. Going into the third quarter, what are you seeing?
We're seeing good activity, good performance. Now, it's obviously early in the quarter to talk about it in July, but in terms of both the FIC business, fixed income and currencies, and our origination advisory business, good start to the quarter, and that gives us some real confidence about what lies ahead in the second half.
And what also may lie ahead is a buyback. I know it's sitting now with the ECB. Analysts are expecting something to the tune of about 400 million euros. Is that broadly in the right ballpark?
We can't comment on size, but we're pleased to be in the position to have submitted only a couple of months ago now the application to the ECB. There's a process that we go through, so we can't speak to size at the moment. But we were pleased to be in a place of incrementing the originally announced buyback and executing, in a sense, throughout the year.
And so your base case is to be able to deliver on that buyback by the end of this year?
Absolutely.
Okay. And in terms of tariffs, I'd like to get, we've been talking about tariffs for a while now.
We have.
I'd like to talk to you about the idea that, because you're talking about it's holding back corporates, right? But there's also this underlying kind of bullish sentiment within Germany, a lot of investment and a lot of private investment also coming in that we talked about a little bit earlier in the week. Is there a sense from you that there's a lot of pent-up business that's just sitting on the sidelines? Can you give us kind of an idea of what kind of volumes we're talking about and what it would mean for you?
There is. Hard to translate into volumes because it's a bit of a guess.
But in the event of a deal, do you see just a huge flow of
We do. It's so this uncertainty, it's fascinating talking to clients. The impact on any given client's business of the tariffs, whatever the arrangement will be, can be very varied, depending on the foreign content and what they sell in the United States, depending on where the manufacturing takes place, how much intellectual property, and the supply chain underneath it. So it's a very varied thing. But as a consequence, until people see sort of what the final agreement is, it's very hard to make investment decisions. And so that is absolutely holding people back.
Deutsche Bank CFO there, James von Moltke, speaking to Bloomberg's Oliver Crook. Let's bring Ollie into the conversation, shall we? He has, of course, been talking there to James von Moltke and can give us his reflections on the conversation. Ollie, what stood out to you?
Yeah. So Anna, listen, there's obviously the numbers that stood out with FIC beating up 11%. That is better than anybody really had anticipated in terms of what we were expecting from Deutsche Bank. They've been consistently beating on FIC, which is obviously the sort of investment bank division that everyone's really sort of very focused and preoccupied on. Positive news on giving back a buyback. But I think what's really interesting for Deutsche Bank is there are a lot of these sort of structural tailwinds, a lot of things that will propel this business potentially for a very bullish story in the next couple of months. And you're seeing that reflected in the stock move today. I mean, up almost 6% today. That's the biggest move since April the 10th, when basically the tariffs from the United States were delayed. And when we go through some of those bullish sentiments, you have the buy Europe trade. When I spoke to the CFO, James von Moltke, he says that is very much intact. This idea that conversations he's having with clients, not just in Germany, but across the world. He said he was in Australia and spoke to a lot of institutional clients there, looking for ways to gain further exposure to Europe, to reduce a little bit of that exposure to the United States in the wake of all that volatility. Of course, there is the question of a tariff deal, which we may be potentially approaching for the Europeans, getting a trade deal with the United States. That, again, would see a huge amount of money that is currently sitting on the sidelines in Germany, and sitting on the sidelines for a very bullish story in Germany, where we've talked about the government unleashing hundreds of billions of euros potentially in spending. So all of these are sort of very structural tailwinds for Deutsche Bank going forward. And again, that is something that seems to be cutting through to the market there, up about 6%. And let's say nothing of course, all of the macro uncertainty. One of the things that certainly will get a lot more spending over the next couple of years is the defense sector, and that is a sector that Germany is quite exposed to with a number of different stocks, and that is something that Deutsche Bank is trying to gain additional exposure to going forward.
All right, Bloomberg's Oliver Cook on the latest on Deutsche Bank. Let's broaden out the bank's focus now. We've had many banks reporting this morning: BNP Paribas, Sabadell, and Lloyds also out with results. Joining us now is Tom Metcalf, who leads Bloomberg's EMEA finance coverage. Tom, do we have a decent overall picture now of how European banks are faring?
Yeah, well, we've had plenty of banks reporting, and I would say, yeah, a bit like Deutsche Bank, most of them probably pat themselves a bit on the back, with the shares across the board are up. And, if you take Sabadell, they've come out with a very clear plan for how they should stay independent. They're obviously fighting off a takeover attempt from BBVA. And then in Lloyds, great bellwether for the UK economy. Again, very, very benign. They're not seeing any kind of big losses sort of bubbling up from consumers. And so, broadly speaking, again, positive news story there.
Yeah, we're going to have a conversation with the CEO at Lloyds Banking Group a little bit later on. Sticking with other banking themes, we had numbers from BNP. We spoke to the CFO there. That stock up. A great deal of confidence about the trading revenues that they have achieved and what can be repeated into coming quarters. I mean, I guess nobody knows, because we don't know what kind of volatility we'll see in markets. But we do seem to, we heard it from David Solomons as well, quite positive about what's repeatable in those businesses.
Yeah, very bullish sentiment, I thought. And again, on the fixed income side, for me, the BNP Paribas results, again, very strong. The only interesting thing there was they also have an equities trading division, and that actually declined, which is completely counter to what all the US banks were doing. So that was kind of an interesting sort of outlier. But again, broadly for BNP Paribas, it's positive news.
OK, thank you very much, Tom. Thanks for joining us. So we've got mixed fortunes, perhaps, for the banking sector in terms of where their share prices are moving. So BNP is up. Deutsche Bank is up really strongly, up by 6%. Lloyds Banking Group down by 1.5%. And as I say, we will be speaking to the CEO of that business a little bit later on. Now, sticking with the UK, coming up on the programme, the former star trader Tom Hayes joins us next, following the decision by the UK Supreme Court to overturn his conviction for rigging LIBOR benchmark rates. This is a story that goes back more than a decade. It resulted in the abandoning of LIBOR as a global benchmark. It had far-reaching consequences for the financial services sector, and certainly, personally, big consequences for Tom Hayes because he went to prison initially. So we will certainly look forward to our conversation with Tom Hayes. That's coming up shortly. This is Bloomberg. This is the opening trade. It is 8:30 on this Thursday morning, and this is a picture across European equity markets then. Really quite positive. A lot of expectation around tariffs seems to be building into markets, although maybe we're off earlier highs, but expectations around tariffs seems to be the big driver, and earnings. Valerie, we've got some breaking news coming through from the German market.
Anna, let's take a look at how these PMIs are faring. We had the French ones. There was a slight beat in those numbers, but it does look like we are having a miss when it comes to German manufacturing PMI, rising 49.2. The forecast was for a print of 49.5. The composite also coming in weak, Anna, falling to 50.3. The forecast was for 50.7. So at least the composite is in expansion. Oh, services PMI also entering expansion. A slight beat on the services figure, Anna, rising to 50.1. The forecast was for 50. It does seem like there is not a lot of movement in FX space off of these numbers. We do await the broader Eurozone numbers to come in around 30 minutes time. We also get the flash PMIs out from the UK and the US later. Anna?
Yeah, absolutely. So waiting for further data, also waiting for an ECB rate decision later on today. So no doubt those trading euro are watching that very carefully and closely. Now, let's change pace slightly on this programme. Tom Hayes, the first banker to be jailed over the LIBOR rigging scandal of 2015, has won a bid to overturn his criminal conviction, clearing his name a decade after he was sent to jail. In a stunning reversal, the UK Supreme Court yesterday quashed the convictions of Hayes and ex-Barclays trader Carlo Palumbo. The court allowed both appeals, stating that the juries had been misdirected by judges at both criminal trials. Tom Hayes, I'm pleased to say, is with us now here on set. Good morning.
Morning.
You've had a really busy time, talking a lot post this decision from the Supreme Court. It must. Have you found the words? Yesterday you said it was difficult to sum up how you felt outside the Supreme Court. You'd had a lot of time to think about it, but have you found the words to describe how this feels?
Well, I've had 4 hours sleep now. It's sinking in. I actually found out the decision 24 hours ahead of the announcement in court, so I didn't quite have the drama of the announcement in court and going wow, because I knew what it was already. But yeah, I mean, I'm still wondering whether I need to email my probation officer to see whether I should be meeting her next week. But it does feel a little more real today than it felt before. I think actually having the piece of paper in your hand makes it more real. Yeah.
And so this has made a huge difference to you. Clearly, it will perhaps make a difference to others who found themselves in a similar position. Have you talked to any of the other traders who were also convicted at the same time?
Yeah, all of them. I mean, yeah, all the other 7 convictions, they all need to go. And really, this is a battle in a war, and we've won the first battle. I don't see really how the SFO and the prosecution can contest the appeals of the other 7, because none of them should have been convicted, none of us should have been convicted. So,
and are they going to challenge them in the same way? Do you think?
From speaking to them and without wanting to sort of, preempt what they might do, I would be very, very, very surprised if they don't.
OK, so that's the conversations you've had. And I know you've also said it's too early for you to say what comes next.
Yeah.
Because you're still, dealing with the news flow, thinking about this decision. Do you have any thoughts about where it goes? I mean, do you have a future in trading, a future in banking? Is that where your aspirations still lie?
I've got friends who, run funds over in Hong Kong and stuff who I might be able to go and work with, whatever. I've got no idea right now. I mean, to be honest with you, I don't quite know my regulatory position, because the last thing I had from the FCA was they tried to ban me for life, and that was stayed by the courts. That should not now go ahead because I've had my conviction overturned. But, I just don't know where I stand from a regulatory point of view, certainly in this country, even though actually the Japanese regulator where I worked didn't actually sanction me on any basis. So it's all a little confused at the moment, I would say.
Are you looking to get to the bottom of that, about where you are allowed to work? You mentioned Hong Kong. Are you looking to get some sort of resolution? Because maybe that sounds interesting, to stick in the financial services sector.
I don't know. I've worked out in Asia for a long time, in Japan. And, I need to really sit down and have a think, because I've been out of the markets for 15 years, and that is basically a lifetime. I talk to my friends who are still in the markets, and they tell me things that, I just think, oh, I didn't even know that, I didn't know that, I didn't know that. I mean, markets move so fast, and we've gone from, from what I understand, is a lot more automated market making, algorithmic stuff than it was back in my day, when Microsoft Excel was king, So
it's changed a lot.
Yeah, I would need to catch up,
Yeah, you've been through so much in the last 10 years, 15 years even, Tom. Do you ever wish that, I mean, you changed your plea early on in the process that might have led you to go to prison for less time. Do you ever look back and think maybe I should have not done that and played it differently, and this would have been over a lot sooner?
I mean, it's a thought process I've had a lot, because I was on a cooperation programme which would have entailed me giving evidence against my co-defendants and pleading guilty, and I did that, and I made false confessions in respect to that to avoid a 200-year indictment and extradition to the US, which ironically I would have been better doing because I would have been exonerated at a far earlier date. But I don't regret that decision, because it was a contributory factor in all my co-defendants getting acquitted at a separate trial. If I'd had to lie about those guys and they'd gone to prison, I don't think I could have lived with that. So, you know, when I was in prison, I felt like I was doing 1 year for each of my co-defendants. It also meant I was in a conspiracy of one to manipulate a rate that I didn't even choose. So it made it sort of a bit even more nonsensical.
Do you feel, you use the word exoneration there, do you feel exonerated by what happened in the Supreme Court yesterday? I mean, clearly the conviction has been quashed, so that's, you know, victory. But in terms of the language that they use and some of the wording, do you feel exonerated?
I do, because the issue in our case was falsity was never put to the jury, and we never put rates forward as submissions or asked for rates to be submitted that were false. You know, were they commercially influenced? Yes. You know, we can have a morality trial about that. That was a system. The benchmarks were set up by the banks for the banks. Every bank had, you know, a commercial interest in the rate that it submitted. Every trader who submitted a rate traded products that was attached to the rate. The whole thing was just badly set up. And it's all very well after the event 10 years later to say, well, we don't like the look of this and somebody's got to go to prison for it. But no one lied. And people talk to me about, oh, what about your managers and this, that and the other? But I'm not running a Nuremberg defence. My managers shouldn't go to prison either. I mean, because nobody lied about the rates. I mean, you know, they were all rates that were offered and you could borrow at. So what would you do? Roll a dice? You know, toss a coin? Or just say, well, I've got a fiduciary duty to my employer to do the best for them.
And has this whole thing left us with quite a lot of grey area, I suppose, is my question, Tom? Because what the jury said, what the Supreme Court said yesterday is that in each case there was ample evidence, and you know these words, on which a jury properly directed could have found the appellant guilty of conspiracy to defraud, but the jury was not properly directed. So the judge should have left the jury to decide, but he didn't, and so now we don't know what the jury would have decided. Would you have hoped for something that was a bit less grey?
No, I think that's fine. I mean, because we made commercial requests, and if the jury had taken the inference that commercial requests was in some way false, they could have convicted us. But the other evidence points squarely away from that. The other evidence where I actually say in emails, you know, I don't want something that isn't a true number, is there. And so one thing is I think instructive, which is the fact they haven't sought a retrial. Because I sort of actually wanted a retrial, to be honest, a retrial with fair directions and a whole load of things that happened in my trial beyond that, including people who subsequently changed their evidence, unqualified experts, which the prosecution knowingly instructed and paid £400,000 to. All of those things would not be in another trial. And so I think they're perfectly entitled to say that there was ample evidence because there were lots of requests. And how the jury interpreted the requests would have been up to them.
Yeah, and the SFO has said that no retrial will take place, as you say, because it's not in the public interest. So, will you consider taking other legal action, Tom? Is that something you're exploring, talking to lawyers about?
I've had so many lawyers in my life for the last 13 years, and I've still got lots of lawyers in my life. There are discussions about what avenues are open to me in that regard. I mean, certainly in the US, the guys who were exonerated by the Second Circuit in the US, they all took their former employer banks on a civil basis, and there's been settlements reached in all of those cases. So I don't know. I mean, look, I'd just best to leave it to the lawyers. That's the go-to words of my last 13 years.
Yeah, and stepping back from what you've been through, Tom, and what the industry has been through, I suppose, because it isn't just you, it's others. And as we've just discussed, there's still this. Maybe there's too much grey, although you say it's fine. I mean, what lessons should we take? This was all post-GFC. This was a very heated political environment where people wanted answers and people wanted somebody to pay a price for what had happened. That's the context in which this took place, I suppose.
Yeah, I mean, we were vilified. All bankers were vilified. It was ridiculous. If you look at this, you know, the so-called FX fixing scandal, you've now got 0 convictions on the back of that. Soon, hopefully, we'll have 0 convictions globally because of LIBOR. We were scapegoated. We were accused of causing the global financial crisis, which we had nothing to do with. How, Japanese yen LIBOR moving around by 1/1000th of a percentage point had anything to do with the global financial crisis is completely beyond me. But the narrative that was driven and the false narrative that's been so hard to turn around from a public perspective, not necessarily in the markets. Anyone in the markets generally knew this was just, ridiculous, because anyone who's traded in the cash markets knows that you've got a number of offers and you can choose one of those offers. And, the mechanism for choosing them isn't prescribed. And actually, the banks, the other derivatives traders setting the rates, and it was sort of par for the course to set the most commercial advantageous rate. So I just think that, we were definitely scapegoated.
Yeah, I mean, you weren't surprised to see the back of LIBOR then, given what you've been through and how you describe it worked?
Well, actually, the replacement they made immediately after, which is where they placed the submission process, behind the Chinese wall, that person had no idea of the bank's commercial positions, was totally fine. And I don't think they didn't need to move to SOFR, the secured overnight funding rate. I thought that was not necessary, because now you've removed that element of credit, of bank credit, that LIBOR always carried inherently. Yeah. So swap spreads and stuff like that have all sort of disappeared. So I think it's a shame. And it's interesting, your RIBOR didn't go. They kept your RIBOR. So yeah. I think, obviously, the US wanted to pull their benchmark rate back to the States and set it in the States. So maybe, that had something to do with it.
You sound like a person who's still interested in markets, Tom, to go back to where we started the conversation.
I think they never leave you, do they, really?
It gets in there somehow. Can I just ask you, we've heard talk that somebody might be making a drama out of this. There might be plans to film it in some way, a film or a TV series. Is this something that you've heard about?
Yeah, there's stuff going on in that regard, but I can't talk about that at the moment. So,
okay. Any thoughts on who might play you?
I don't know. They'd have to be in their early 30s or mid-30s, because it started for me when I was sort of 26, so they'd have to go through from 26 to 46.
Okay.
So I wouldn't mind who played me.
We're looking for someone with that range. Thank you so much for coming in, Tom. Very good to speak to you. Nice to have you with us on the programme. Tom Hayes, former UBS and Citi trader, of course. Coming up on this programme, we'll get back to some of the corporate earnings stories. Charlie Nunn will be with us, the CEO of Lloyds Banking Group. We'll get into what that business has reported this morning, what it says about the UK economy. This is Bloomberg. Welcome back to the opening trade. 46 minutes into a session that looks really positive, up by 0.9% at least on the Xetra DAX. The FTSE a little bit weaker than that, and in fact the CAC Carron's a little weaker, but there's still this optimism around trade and the earnings story certainly permeating. Let's get to that then. We've had numbers out from Lloyds Banking Group, second quarter pre-tax profits coming in above estimates at £1.99 billion, and the guidance reaffirmed for 2025. Also talking confidently about 2026 guidance. The stock down a touch this morning. Let's bring in Charlie Nunn, the CEO of Lloyds Banking Group, who's with us this morning. Charlie, a very good morning to you. You say you're confident about 2026 guidance. You're reaffirming the guidance today. Any weak spots in the earnings at all then, or is it an entirely positive story you're telling?
No, I think it's a strong performance over the last quarter and, in fact, over the last year. I think critically, we announced a strategy pivoting back to growth, really innovating for our customers, winning market share. We've seen 6% year-on-year growth in revenues, 9% on other operating income. And in the core businesses, mortgages, transport, pensions, infrastructure investments, we're winning. So it's a good foundation for the next 2 years. And we reiterated our confidence for 25 and 26, as you said, and also announced a 15% increase in our interim ordinary dividends. So good capital generation and returns to shareholders.
When I think about your business, I don't necessarily think about tariff impact, but of course any banking group that serves an economy is going to face tariff impacts in some form. You say in your release today that the tariff-related £100 million central adjustment was released. Tell us a little bit more, if you can, about what that is, how the tariff story impacts you.
Yeah, so just the broader economy, maybe just start there. We've announced today slightly updated forecasts We've for a while had what we call a very resilient but slower growth economy. We're predicting about 1% growth in GDP this year. The tariff impact since the start of the year, mixed with some other factors, probably had about a 0.2% reduction for the UK in that context. So meaningful, but not huge. And the adjustment we were talking there was around the accounting adjustments for our ECLs, our impairment line, which is a smaller part of that view. Look, underlying that, what we're seeing is the UK economy has some real strength. So UK households have increased their deposits and savings 6%. Businesses, small and large, we're seeing stronger cash flows, and there's actually quite good business confidence in the UK. So our hope is, and sort of our ambition, working with our customers, working with the government, is actually we can get to a higher growth trajectory, building on those strengths.
Charlie, you sound quite positive about UK growth, about your business. Why didn't you raise guidance at this time around?
Well, we already had very stretching guidance for this year and next year. We've always had a view, working with our board, that we wanted to be realistic and stretching in our ambition. Our 2026 ambition is for our investors to get to 200 basis points or more, greater than 200 basis points of capital generation, and a 15% return on tangible equity. So we're heading in a very good pathway towards that. And we very much believe in setting ourselves stretching ambitions, which we then deliver. And that's what we've done again this quarter.
Charlie, I guess one overhanging concern for investors is the provisions you've set aside for motor finance. I see that you haven't changed that provision. It still stands at £1.15 billion set aside for those remediation costs. We're yet to hear from the UK Supreme Court on this ruling. They're due to rule on it this month. Is that reflecting positivity, the fact that you didn't necessarily increase your provisions set aside?
No, I think it's what you said. Actually, the new information we're waiting for is both the Supreme Court, maybe next week or the week after, is what is most likely. And then critically, actually, our regulator, the Financial Conduct Authority, has said that they will then come out with their view, which is probably even more important for what it means for customers and what it means for us. So no new information at this stage. The provision we've done, we think, is our best estimate. It could be higher or lower than that. And we'll update if there's any new information and when it's right to do so.
Charlie, we've heard quite a bit from the government on its plans for financial services recently. There were the announced Leeds reforms on the same day as the Mansion House speech. The detail is interesting, but in terms of the bigger picture, we spoke to Nigel Wilson recently, who said we don't live in an investment culture in the UK. We have a savings culture, and we need to pivot more towards an investment culture. Is that a sentiment that you recognise? Does your thinking fit along those lines?
Yeah, I mean, so first of all, I really welcome, and we really welcome the Mansion House reforms. Having a government thinking about longer-term growth and competitiveness for the real economy, and then also for financial services, is one of the most important sectors we think is going to be really good for the trajectory of the UK over the next few years. Now, in terms of investments, we definitely agree there's an opportunity to support more people in the UK with investments. Some of the changes since the financial crisis have meant that advice around especially equity and debt investments is really limited to those who are wealthier. And actually, everyday people need to have more access to that service. So there's some specific changes within the Mansion House reforms that we think can extend that. And we, of course, also have a leading pensions platform, over £200 billion worth of pensions money being managed for our Scottish Widows business, which is growing well, which is a brilliant way to provide access to customers to take risk appropriately and manage their longer-term financial resilience. So very much welcome the focus on that. The one thing I would say is, people need to have a holistic view of their wealth, savings alongside investments. And then in the UK, real estate is such an important part of wealth. If you just take a step back, there's about £7 to £8 trillion worth of real estate which isn't mortgaged. And that's by far the biggest investment and wealth asset in the UK. There's about 2 trillion of defined benefits, 1 trillion of defined contributions, and then cash investments are actually smaller than that. So to really support customers, you need to be thinking across those areas. And the great thing for us is we're a leader in all of those, in mortgages, in pensions, as well as helping manage cash and bring investments to UK society and UK households.
Charlie, you mentioned pensions there, and we can talk about this proposed pension reform that the UK is looking at, maybe forcing pensions or tempting pensions to hold more UK assets. I see you've been quite critical of that kind of reform, calling it capital controls. Do you have any words of advice for the government of what kind of pension reform you think would be useful for the British people?
Well, we think the real focus here needs to be on helping people invest appropriately. And that's what we've been focused on. And we really welcome the government's focus on trying to invest more in the UK. And at Scottish Widows, that's exactly what we're doing. So we have over 21.5% of our Scottish Widows assets invested in the UK in both public and private equities. And we think actually providing choice to our pensioners and trustees is at the core of that. And that's very much what we're focused on. Now, as you know, the UK probably represents, it depends on the asset class, 2 to 3% of the world's investable assets. So there's a great opportunity already that we're taking advantage of to create a bias for our pension customers to the UK. And we've just announced the launch of our long-term asset fund, which is going to provide additional opportunities for our pension customers to invest in the UK going forward. So welcome the direction of the government's plans around this. We think we can do that as a competitive pensions provider very successfully, and we're proving that so far.
Charlie, thank you for joining us. I know it's been a busy morning for you. The CEO of Lloyds Banking Group, Charlie Nunn. The European Central Bank is set to leave interest rates untouched at 2% for the first time in more than a year as it awaits clarity on what President Trump's tariffs will do to inflation. Bloomberg's Lizzie Burden is outside the ECB headquarters in Frankfurt. Lizzie, set us up for this decision.
Hey Val, well, it looks like if you look at our survey, all but 2 economists see a hold from the ECB today because by September they'll have more detail on trade, hopefully, more data and certainly those new forecasts. So they should have more clarity by then. But this US-EU trade deal that's potentially just around the corner, according to our reporting, could be what decides whether today starts a hold or the end to rate cuts. Economists at Berenberg and RBC say that if you get a 15% tariff deal, you wouldn't need to cut again. But our economists at Bloomberg say that even if you got 15%, that's higher than the 10% that was in the June forecast from the ECB, which had suggested you'd still have a cut in September. And you've still got to factor in the sectoral levies. So our economists say that you'd still need cuts in September and December. Look, there's a lot of uncertainty out there. I think, Val, that Christine Lagarde is going to keep her cards very close to her chest today. I'll be interested to hear what she says on the euro, particularly after Luis de Guindos told us at Sintra that 120 is the level that complicates matters for the euro area economy. I don't think Christine Lagarde will be as precise as that. And she's also making this argument that the euro needs a bigger role on the global stage, so hard to put the two together. But what I will be listening for is if she's a bit more humble about how good a position the euro area economy is in. The last time sounded a bit like a victory lap. If she emphasises the downside risks to growth, the market is going to seize on that as a sign that a September rate cut could be on the table.
Lizzie, thank you. Bloomberg's Lizzie Burden outside the ECB. So, Valerie, the end of the programme, time to take stock. You're disappointed by the performance of chips this morning.
I am. ST Micro down 12%. This comes alongside, we just heard from Alphabet about their increase in CapEx spending, boosted NVIDIA and Broadcom in the session yesterday, but doesn't seem to have that much of a fall through to the European chip makers today.
Yeah, absolutely. But European stocks are moving higher. The stock 600 up by 0.5%. That is it for the opening trade. I'll be here with the pulse next. This is Bloomberg.